It better be good. It better not disappoint. But I do think the silver lining here is that think about how many tech companies either suspended guidance altogether, or they had a negative pre-announcement, or the analysts took down their earnings estimates. And for example, if you look at communication services, if you look at Infotech, the earnings estimates for this quarter are negative 15%. So I think that's a very low bar. But, companies like Netflix better surprise to the upside. Now, I think the scope for surprise is there because, Scott, we talk about how economic data has been continuing to surprise to the upside. I think consumer may also surprise to the upside. We saw the retail sales last week that was sort of bad, but once you dig into the details, guess what was strong? Consumption on food and beverage was strong, but also online retail was strong as well. And overall, consumers are prioritizing leisure, entertainment over durable goods. So I actually think that bodes well for parts of tech.
You're not positive on most parts of the market, Mr. Lerner. However, technology is one of the places you're actually overweight.
It is, but I'm not actually super excited about it. So that tells you why we're not super excited about the market at this level. So I think with tech, they have some levers right now, right? This is the year of efficiency, and we're seeing that they're pulling that lever. So I think these tech companies will continue to outperform on a relative basis. The challenge I see is that you're trading at a 30% premium for the sector relative to the broader market. So the question becomes, how far can tech take this market by itself? We actually just looked at some interesting data. Over the last 3 months, only about 26% of stocks within the S&P are outperforming the S&P. So what does that tell you? Well, tech has been the driving force.
Top heavy. It says that this whole thing has been top heavy since the start of the year.
You need this to burn out, and maybe that's that glass half full that you have opportunity to burn out. But in our view, if you're already trading at one of the highest valuations in the last 20 years for tech on a relative basis, where's the big upside for this market going to come from?
You feel like tech's vulnerable here?
I mean, I don't. And the reason I say that, yes, maybe the multiple is higher on tech and higher on, the NASDAQ than it is on the S&P. But I think there's two differentiating factors for technology. First of all, look at margins. Who has the highest margins in the S&P 500? It's technology and software. So there should be a premium in valuations for that. And then the second point, if you look at the earnings CAGR, the earnings growth for the next 2 years, for example, Scott, for the S&P, it's averaging about 8%, which may be high. But guess what? For the NASDAQ, it's about 14%. Right. So it's all about how much you're paying for a unit of growth and for the margin. And I think the story there is positive for tech. And then the other thing, too, is I do think we're towards the end of this hiking cycle. And that means this valuation headwind may not necessarily be a tailwind, but it's not going to hopefully move the multiples one way or another. And in that environment, if tech multiples are stable and earnings growth actually outperforms the S&P, I think that's a good setup.
Bostic was on our network. Raphael Bostic, Atlanta Fed Prez earlier today. Keith said my baseline, one more hike for sure, and then we're going to hold it there. And he doesn't have recession as his base case either. What do you make of that?
Well, first thing, I think there's a lot of debate whether they're going to raise one more time or not. I don't think that's that important. I think the bigger picture is the end of the tightening cycle is near. And then the question becomes, historically, what comes next? Historically, you get a bit of a short-term rally, and I think that's part of the reason why this market has rallied.
Wait a minute. Why are you negative then?
Well, because as we go into the second half, part of the sustainability of a rally is whether you go into a recession or not. I know there's a lot of debate, soft landing, hard landing. We think the economy is going to slow in a meaningful way by the end of this year. And then when I look at the earnings side of this market, we talked about multiples being relatively high. I see a disconnect. I see that the industry analysts are expecting earnings for the S&P in the back half to come back to an all-time high. But I look at the economists, and they're looking for a significant declining in the economic growth. So I think there's a disconnect. I think you don't have to be bearish, but at a minimum, that just tells us our view is that the upside is likely capped. I realize the one positive right now is position is still relatively light. So that may stretch things a little bit, but if you're looking like we are the next 6 to 18 months, it's not something that we feel like there's a lot of upside in this market.
Well, I mean, it makes perfect sense to be bearish, though, if you believe that earnings are still too optimistic and that estimates are still too high. Like Mike Wilson, for example, at Morgan Stanley has been routinely bringing up, including, again, this week.
And I don't even think you have to be overly negative on earnings. If I say that the earnings for the next year are money good, which I think there's actually downside, you're still trading at the highest level of the S&P over the last 30 years outside of two periods, the pandemic overshoot or the technology bubble. So you have to really, at this point, to be positive, you have to assume one or two things. One, we're going to trade at those higher those high valuations that we've only seen twice, or that earnings are going to be much stronger than the consensus.